Welcome back to Hustle Front. Investing in the stock market is something that you'd want to do at some point in your life. But the question is, at what point should you go to invest in the stock market? There seems to be a disconnect between what the market is marketed for and what it really does. In my opinion, this market should be used to preserve wealth, not to build wealth. And here are 5 reasons why I believe, as a small player who doesn't have much, you don't have much in terms of income, this is not the right place to build your wealth. Coming up. Point number 1 is it violates the commandment of control. If you watch my earlier videos about good business ideas, is that one of the most important commandments, you should have control of your business. It may not be 100%, but it should be significant. So whenever you buy a stock, what happens is you resign to hope and time. You buy and sit back and hope at the company that you have bought is going to keep growing with time, and you hope the people managing that company will do the right thing to ensure the growth is consistent. That is what happens whenever you buy. You have no control. But you may be asking, how do the likes of Buffett, Carl Icahn make money? They are not traditional investors. I want you to go and investigate how they make money, how they buy their stocks. They are not the kind of people who buy and sit back. These guys buy a huge chunk of stock. They have control of what the management is doing. They influence the management activities. They influence activities of that company. They even advise those companies to tap, those opportunities that they're not, tapping in the market. So these are not the kind of traditional investors. So comparing yourself to them and hoping that you'll ever get to where they are not the normal investors. So as a small player, you don't have much. You don't have the leeway they have. You don't have that influence. You don't have that control that they have. So I think this is not the right place to make your money. So be like them. First make a lot of money, and then you can exert such kind of influence whenever you buy stocks. Well, I know this may sound extreme, but it's like watching Manchester playing Arsenal when you've made a bet. So what can you do from where you sit? How much can you influence the results of the game? Not much. Not even at all. So when you're investing in the stock market as a small player, I think you have a similar situation where you have almost zero influence apart from selling and buying, nothing much. Who wants to be in such situations when it comes to making money, when it comes to building your wealth, where you have no control? So point number 2, it's a volume game. So there are 2 ways you can earn money in the stock market, either in terms of interest or income from dividends or from the bonds that you've bought, or in terms of price appreciation for the stock, that specific stock that you've bought, or that bond that you've bought. So let's take an example. So if one guy has 1,000 shares of a specific company and another guy has 1 million shares of a specific company, if the price changes, let's say talk about a price appreciation. If the price changes with 1 shilling, this guy who has 1,000 shares is going to make 1,000 shillings, and this guy who has 1 million shares is going to make 1 million shillings. So this is a volume game. The more you have, the better. But the question is, when you're young, when you're a small player, do you have such kind of financial muscle? Most of us don't. So this is not the right place to play. This is not the right field to play when you don't have much, because volumes seem to act in favor of those who have much. Number 3, it's a zero-sum game in the short term. What do I mean by this? For someone to win, someone has to lose. The reason I'm saying this, especially if you're flipping stock in the short term, if you're a small player, as I'm saying, you want to remain liquid. Maybe you're paying rent. This is what you're relying. This is the only income you're relying on. You're paying rent, you're paying some other expenses, you're paying school fees. So you want to remain as liquid as possible. So for you to win in the short term, if you're flipping stock, someone else has to buy what you bought at a lower price, at a higher price, so that you make money. So if you're looking at it that way, it's a zero-sum game. So every time you win, someone else has lost. And sometimes the loser could be you. Who say you can't lose? So it's a risky game. This is not where you want to be when you're trying to build wealth. If you to refer to the first point where you don't have much control, you don't want to play this kind of game. Point number 4 is that markets have become so irrational, or people in the market have become so irrational. There are so many hitchhikers sitting there waiting for Buffett to say something. Whenever he buys, they buy. With no good reason. They don't know why they have bought those stocks, but they follow him. Whenever he sells, they sell. So even in the short term, even after doing due diligence, doing the right research, you may find yourself losing stocks just because somebody tweeted something. I heard the other day Elon Musk tweeted something. People followed and bought a lot of stock for that specific company. So you have to be careful. In the short term, it's very tricky to operate in the stock market. So if you're trying to build wealth, you may suffer out of tweets, out of influence. I don't know why people are so irrational. They're acting on any kind of information. So I think wealth maybe have been concentrated to very few people who have a lot of influence in so many people. So whenever they tweet something, people think it's serious. Anyway, it could be serious, I don't know. But that irrationality can cause trouble to somebody who is trying to build wealth in the short term in the stock market. The final point is what I call compound interest line. Compound interest is a beautiful concept. It works very well and can really help you build your wealth over time. So for example, if you have 100 bob, 100 Kenya shillings, if you invest it for 50 years with a 10% interest rate compounded annually, at the end of the 50 years, you're likely to end up with around 11 or 10,000 or thereabouts. So if you do the same, if you saved 100 bob monthly and compounded it annually for 10%, you're going to get, after 50 years, you're going to get about over 1 million shillings. Sounds really good mathematically. But let me ask you, where in this market for 50 years can you consistently get 10%? 10% consistently for 50 years. Which market does that? Where do you get such kind of a rate? Again, the question is, some of us start late. Do you have 50 years? Let's say you started investing at 40. Do you have 50 years to wait for you to get to 1 million? So compound interest is a good thing. And again, as I go back, for a small player, some of these things may not be very good. For a big player, if you have a lot of money, if, for example, you have 1 million, which is compounded for 2-3 years for 10%, you can make a lot from there. Because in the short term, rates tend to be, a bit stable. But in the long term, there are no companies. Can you tell me in this country which company has performed very well for the last 50 years? Which company? So it's tricky. When you subject compound interest to something we call time and reality, you are likely to see you should not trust this concept, especially if you're a small player. Because there are no markets that consistently can perform with a single rate. It's not realistic. It is only possible mathematically. It sounds mathematically nice, but in reality, it is not true. So you have to be very careful when you're following some of these concepts. But compound interest, when you have a lot of money, it's so nice. Because for 1 year, if something is compounded annually, or for 2-3 years, if it is compounded annually at 10%, you make a lot of money. But when you're a small player, they tell you have to wait for 50 years. You're not very sure what is happening. Corona came the other day. Nobody could predict. There was 2008 financial market crash. No one could predict. People had made money for 10 years, but out of nowhere, they had zero. So there's nowhere you can get some of these. Compound interest is a good concept in the short term, but in the long term, if you subject it to time and reality, it may not work as they say. It may not be as nice as they say it. So be careful when you are following some of these concepts. So thank you very much for watching. And as MJ DeMarco says, use the market for what they are for, what they do, not what they are marketed for. So people will tell you you can do this in this market, but you should investigate and see exactly whether it's possible to do that. So to learn more about this concept and to get more details, you can read his book, MJ DeMarco's book, Unscripted, and learn more why you should not go to the stock market to build wealth, rather to preserve wealth. So see you next time. Wish you all the best.